Hello friends, welcome to today's session. I am CA Renu Srikanth Tantry here. In today's session, we will learn about passing of journal entries when GST is involved. I split this topic into two sessions. We have already discussed the basics of GST in the last two videos. So those who have not viewed those videos, please do view it. It will help you in understanding how we are passing the journal entries in the books of accounts, which we will be learning in today's session. So friends, let's start today's session. Now I have split this passing journal entries into 6 sub-cases. We are going to be learning first 3 cases, how we are going to pass journal entries in today's session. And the next 3 cases of passing journal entries we will be learning in my next video. So let us start. The first 3 cases that we are dealing with today would be GST paid and allowed as input credit, GST charged and collected and which is an output GST, and GST which is claimed as input GST when it is reversed, and how we will be passing the journal entries in those cases. The first case we take is when GST is paid and it is allowed as input credit. Now the first case is when you purchase goods. What happens? When you purchase goods, if those goods are covered under the GST Act, then you will have to pay GST on that purchase to the supplier of the goods. And when you pay that particular GST on your purchase, you call it as input GST. Input GST. Now, there are 2 different cases which you might encounter. One is related to intrastate purchase, the other one interstate purchase. Intrastate means when it is within the state, that supplier and the buyer both are within the state. Then under such circumstance, you will have input CGST and input SGST accounts involved, and the GST rate would get divided half between CGST and SGST. Now, normally when you make a purchase, the simple journal entry that we used to pass was purchases account debit to cash or bank if it is immediately settled, and if it is on credit, we used to credit the particular supplier account in the form of creditors. So to creditors account. But now when this purchase is subject to GST, you are going to be paying GST on that purchase, and therefore the 2 accounts which will be involved, especially when it is an intrastate purchase, would be input CGST and input SGST account. So in addition to debiting purchases account with the purchases value, you will be debiting input CGST account and input SGST account. And the rest of the entry of crediting, if it is settled immediately by cash or by giving a check, that would be credited, and if it is a credit purchase, the credit account will be credited. So to just understand this, suppose let the purchase value be say 10,000. Now if it is subject to GST at the rate of 18%, then being an intrastate purchase, the CGST would be 9%. That would be 9% of the taxable value of 10,000. That would be 900. And SGST at the rate of 9%. That would be also 900. So total 11,800 would be the value of that purchase. So the purchases account debit would be debited with 10,000. Input CGST would be 900 and input SGST would be 900. And if it is settled immediately, it would go here as 11,800 would be paid, or if it is a credit purchase, it would be to the creditors account 11,800 would be payable on this particular purchase. And one more important point about this value on which GST is calculated, it is called as taxable value, which is arrived at after deducting, after we deduct the trade discount and cash discount, if any allowed. So if there is any discount on bulk purchases allowed, then we call it as trade discount, or for immediate payment if discount is given, that is cash discount. In both those cases, you would have to deduct from the value of purchase, and the net amount would be the taxable value on which we calculate the GST. So this is how in an intrastate purchase we would record the transaction of purchases of goods. But if it was an interstate purchase, then instead of CGST HST, you have just one IGST account. So you would debit the purchases account, say the same value will take 10,000, and here input IGST account would be at the rate of 18%. There is no splitting involved here. In interstate purchase, the supplier is in one state, the customer who is purchasing it is in another state. So it is in between two different states, like in Mumbai and Chennai. Two different states. One is in Maharashtra, other one is in Tamil Nadu. So there directly 18%, 1,800 would be the input IGST, and if it was settled immediately, it would have gone to cash, or if settled by check, to bank account. But if it was a credit purchase, it would have gone to creditor's account, 11,800. So this is how, when on purchase of goods, you pay GST. It can be in the form of say GST, SGST, or it can be in the form of IGST when interstate purchase involved. We debited to that particular input GST account. And this input GST account, the credit can be availed against the output GST which is collected by this particular supplier when he sells the goods. Now moving further, now in case of purchase of assets, again we split it into intrastate purchase and interstate purchase. It is the same except that because it is purchase of asset and not purchase of goods, you would be debiting that particular asset account with the value, and you'd be debiting, being an intrastate purchase, you would have input CGST account debited with the half the percentage of GST, and input SGST account being debited with half the purchase of GST. And if settled immediately, you would be crediting cash or bank, and if it was a credit purchase, to that particular vendor account or the creditor account. But if it was an interstate purchase, instead of two GSTs of CGST and SGST, you would have just one input IGST account which is debited. So this is how we record when GST is paid and when it is allowed to take input credit of this GST which has been paid. Now moving further, in case of expenses, also GST might have to be paid. Then under such circumstances, when GST has to be paid on the expenses, you pay the expenses and also GST on it. At that point of time, when the GST is allowed to be taken as input credit, then again we can split it into intrastate and interstate. If the expenses are being paid between two persons within the state, then again you would have the input CGST account being debited and input SGST account being debited. But if it was between two persons living in two different states, then input IGST account is debited, and we would be debiting the expenses with the value of expenses, debiting the respective GSTs here, and if immediately settled by payment of cash or check, we put it to cash or bank account. But if it is not settled immediately and payable later, we credit to expenses payable account. So this is how expenses on which GST is paid would be recorded in the books where input credit is allowed. Now, having understood from the input GST point of view, now we will go to output GST. Now, what is output GST? Output GST is when the supplier is supplying the goods. What happens when he makes a supply on the goods? If GST is to be collected, then that GST would be charged by the supplier and he would collect the GST from his customer, and that he has to pay to the government. So when there is a sale of goods, that is when there is a supply of goods or of services, in those circumstances, GST is going to be collected by the supplier, and that is called as output GST. So first case we will take of sale of goods. Again, sale of goods can be an intrastate sale or interstate sale. If it is intrastate sale, that is within the state, the supplier and the customer is within the same state, again you will have two GSTs, output CGST, output SGST. You're splitting the GST into half and half between CGST and SGST. And therefore, normal entry when there's a sale is if you're receiving amount immediately in the form of cash or check, cash or bank account debit. But if it was a credit sale, you would have debited the debtors account and you would have credited the sales account with the value of the sales. But when GST is being collected on that sale, then you would have to credit additional two accounts in case of intrastate sale, which is the output CGST account and output SGST account. We'll take the same example. Suppose the sales value is 10,000 and if the GST is say at the rate of 12%, then CGST would be in the rate of 6% of 10,600 and SGST would be at the rate of 6% of 600. So total value would be 11,200. So when you put this to the sales would be 10,000, 600 would be credited to output CGST and 600 would be credited to SGST. Total value, either it would be cash or bank account debit, or being credit sale it would be debited debtors account 11,200. The same thing if it was an interstate sale, means where the supplier and the customer are two different states. As I told you, like one is in Maharashtra, other one is in Karnataka. Then under such circumstance, that is interstate sale. Then that particular supply will be subject to IGST. So output IGST would be collected and credited to output IGST account. So in addition to cash or bank account debit or credit sale means debtors account debit to sales account, we will be crediting output IGST account. So if we take the same example, the sales would be of 10,000 and IGST at the rate of 12% would be 1,200. So total value which would be debited to either cash or bank or to debtors account would be 11,200. So this is how when there is a supply taking place and GST is being collected, it is credited into the respective GST account on the basis of whether it's intrastate sale, it would be output CGST account and output SGST account which would be credited. And if it is an interstate sale, it will be credited to output IGST account. Hope it's clear. Now moving on. Now in case of service is rendered and income is received, the same would apply like in case of sale. We would split it as intrastate and interstate. And if it is intrastate, that is within the state, then you would have the output CGST account and output SGST account involved. And normal entry without GST, you would know, would be cash or bank if it is received immediately to income account. But if it is not received yet, then income receivable account debit to income account would have been the entry. In addition to that, now we would be crediting output CGST account and output SGST account with the respective value of GST. So the same case we take 10,000 is the income which is supposed to be received or received. Then CGST at the rate of say 6% and SGST at the rate of 6%. It will be 600 each. So total value 11,200. So you would have income of 10,000 being credited here, 11,200 being debited and 600 being credited to output CGST account and output SGST account respectively. When the GST rate is at the rate of 12%, we split it up. But when it is an interstate sale, we do not split it up. We just credit the output IGST account with 1,200 at the rate of 12% on 10,000 and it would be debited to cash or bank or to income receivable account. So this is how when GST is collected on some service rendered, when some income is being received, then output GST collected would be credited into the output GST account. Now, we have seen that when GST is paid either on purchase or on expenses, we are allowed to take input credit. But in certain cases, on those input GST you collected, sometimes they will have to be reversed. Those circumstances, we will learn how to pass the journal entries. So, the first case I will be discussing is in case of purchase return. When you made a purchase, If it was an intrastate purchase, there was input CGST and input SGST which was paid. And if it was an interstate purchase, you had paid input IGST. Now, out of that purchase that you have made, suppose you have returned some goods. Then in respect of the portion of the goods that is being returned, that portion of goods you have to find out what was the GST associated with that return. And that input, say GST or SGST or IGST, has to be reversed because you cannot claim a credit on that GST because the goods in relation to which the GST you paid is to be reversed. So, normal entry when there is a purchase return, it would be cash or creditor account debit to purchase return, but input CGST and SGST associated with the purchase which is debited, to the extent of it relates to your purchase return, you would have to reverse. So if it was intrastate, you had input CGST and SGST which was debited. So in relation to the value of the purchase return, you would find out the respective GSTs and you would credit input SGST and input CGST account. Or if it was an interstate purchase which is being returned, then you would credit input IGST only to the extent of the value of the purchase return. This is a case where when this purchase return, you have to reverse back, because when the goods are being returned, then the input GST associated with that also will have to be reversed so that you cannot claim credit against output GST. Now, there are certain more circumstances where again there would be reversal of the input GST, like when there is drawings or when there is a loss of goods. Some goods are lost due to fire or theft or any other reason. You have lost the goods. Those goods are no more there. Then the GST that you paid on it will have to be reversed because you cannot claim the GST you've paid on those goods that you've lost against the output GST. Similarly, if you give away a portion of the goods as charity, or you're using it for advertising or distributing it as free sample to your customer, then to that extent your purchase would be reduced. You know that, like if it is drawings of goods for personal use, then drawings account debit to purchase account was the entry. To extent of the purchases which is being reversed because that goods is no more available, it is being taken away for personal use, to the extent of that particular goods which has been withdrawn, the GST which is involved will be reversed by crediting that particular GST, input GST account. So if that purchase was an intrastate, you would reverse the inputs in GST and SGST, and if it was interstate, you would credit the input IGST in relation to that portion of purchase which is being reversed because of goods being withdrawn for personal use. Or in other cases, like if it's loss of goods, we debit the loss of goods account. If it's charity, we debit it to charity account. If it is related to distribution as free sample or advertising, we debit it to advertising account. In those cases, also you're reversing the GST associated with those portion of goods which is no longer available, which is going to be sold and output GST being collected on that. Therefore, you will have to reverse the GST associated with that purchase which is being no longer available. So these are the circumstances in which we are going to be reversing the GST which was paid in the purchases, that is being reversed, so that you cannot claim GST, this input GST, as a credit against the output GST which is being collected when you make the sale. So this is how we pass journal entries when GST is applicable on transactions. So if you like the video and found it useful, please do like, share and subscribe to my channel. And please do leave your valuable comments in the comment section below. So we will continue learning about the next 3 cases in my next video. Until then, take care. Thank you. Have a great day.